And I have been for many years particularly interested in the ways that capital markets have failed local small business. And in the United States, to put this in context, local small business actually constitutes, by our own definitions, half of the private sector jobs. Similar amount of output. And I think, you know, it is to me just daunting how one repairs this, and yet we have made some significant progress in the last year. Most of you probably know about this at some level of general information about crowdfunding, but I wanted to share with you kind of a little bit of the backstory of that. So to just sort of start with preliminaries, why local business? I think most of us understand that local businesses spend more of their money locally, and that tends to give them superior impact on economic development. So this is a famous study that was done by a group called Civic Economics in Austin, Texas, looking at the impacts of $100 spent at a Borders, non-local chain, and now bankrupt bookstore versus $100 spent at Book People, local small business. And what they found, not surprisingly, was that $100 at the local bookstore led to $45 staying in the local economy, and $100 at Borders was $13. So it's not overly simplistic to conclude that if you buy the same book at the same price at the local bookstore, you get 3 times the jobs, 3 times the income and the wealth effects, 3 times the tax collections by the local authority, 3 times the charitable contributions. And the reason for this is that if you look under the hood at both businesses, what you see is that at Book People, they have high-level management on the ground. Borders doesn't. They use local business services. They use local media to do their advertising. They have a stream of profits that come in. And if we could generalize a little bit, there have been about 20 of these studies done, half in the United States, half internationally, and they all consistently find that spending at a local business will generate 2 to 4 times the job impacts as spending at the non-local business. So it's a pretty robust finding, and there's not a single study to contradict this. So it's on this basis that I think a lot of organizing has taken place in the last 10 years in the United States, primarily through the Business Alliance for Local Living Economies, which now has, I guess we have about 80 networks in the United States that represent almost 30,000 local businesses. This information, these thinking has kind of gone mainstream. So this is in the Harvard Business Review in the summer of 2010, and it was a study done by 2 Harvard economists, a regression analysis of 200 metro areas, and basically found that job growth in those areas was positively correlated with the presence of small businesses. And then there was another study that was done in Penn State a few months after that that showed that per capita income growth, so a social equality measure, also was associated with the presence of the local small businesses. The only coherent argument that I have gotten, I've been on the bully pulpit talking about this stuff for 15 years, challenging any economic developer who's willing to engage with me to let's go at it and talk about what works. And I think the most interesting argument that comes back is they say, well, you're right that if we have 2 apples, one local, one non-local, same quality, same price, same convenience, yes, that local apple will in fact generate all these economic development benefits, but the truth is that our apples are never equal, and that local apple is always going to cost more, always be more inefficient, and that local small businesses just don't have the economy of scale to compete with larger businesses. So I have a bunch of responses to this, but one of the points that I make is that if it were true that local small business has been becoming less competitive, we should be seeing in the United States and other countries more jobs migrating to larger businesses and away from the small business sector. And in point of fact, when you look at the data between 1990 and I think this goes to 2009, this is what's happened with the large business sector, 500 employees or above. And there has been growth of about 2%. And what's remarkable about that, two things are remarkable. First of all, this happened in an environment where public policy, especially economic development subsidies, were nearly entirely going in support of global business. So if that public disincentive, that public, in a way, public policy was trying to destroy local small business competitively. If that had not happened, this never would have happened. There never would have been a 2% gain here. The other thing is this is jobs. It doesn't count home-based businesses. And when you put home-based businesses in the mix, the trends actually go in the other direction. That local small business gained market share despite the best efforts of government to destroy them. And it shows how resilient the sector really is. In terms of profits, we know that sole proprietorships in the United States are 3 times as profitable as C corporations. So basically the corporate form that most small businesses either are or start out as is a superior profit-making institution compared to C Corps with partnerships in between. And whatever one thinks of the competitiveness of local businesses now, we know it's improving because in every advanced country, services has become a larger and larger chunk of the expenditures of households. Back in the United States, back in 1960, services was about 1/3 of our spending. Now it's 2/3 and growing. And services is an area where local businesses almost inherently have a competitive advantage. It's only in goods that they've lost some ground. But when you disaggregate where they've lost ground in the goods sector, at least in the United States, 3/4 of our trade deficit is in non-durable goods. And non-durable goods are things like food, paper, building materials, things that you're going to consume relatively quickly. These things tend to have high weight and low value per unit weight. So these are exactly the industries that are most vulnerable to rising oil prices. And it's one of the reasons why I think local food has taken off all across the world. And I have another study that I did for the Gates Foundation on local food businesses. I mean, you know, and it's wild that in places like Zambia or Sri Lanka, local food is taking off as a movement because there's such massive inefficiency associated with global delivery of food. And as oil prices rise, this inefficiency is going to rise. So I think there's this incredible opportunity for a kind of revival of manufacturing around the non-durable goods over the next few years. So a lot of what I do around the United States is promote a kind of alternative form of economic development that's linked with simplistically, 6 Ps: planning, people, partners, purchasing, and policy making. Planning is identifying leaks in the local economy and plugging them. People's how you support and nurture a new generation of entrepreneurs for local businesses. Partners, how do you make local businesses more competitive through groups of action, an example being a cooperative purchasing network that brings down unit prices through bulk purchasing. Purse, how do you bring capital into local businesses, whether from banks or from long-term savings and pension funds. Purchasing, how do you spearhead buy local, or what we call local first campaigns. And policy making, I take just the very modest view that if public policy just simply created a level playing field for local business, it would be a bonanza for them. The critical issue that has come up, in the work that I've done is over and over again capital. I think that, if you talk to businesses in the Bali network, the difficulties that they have obtaining capital are just extreme. And I really wanted to sort of look under the hood at what was going on there. So one of the things that I do with audiences when I speak to them is I ask two questions. So the first question I ask is, how many of you do your banking at a local bank or credit union? Almost all the hands go up. And then I ask, how many of you have your pension funds, your super funds, in local small business? And almost all the hands go down. And what I point out to people is this is a huge market failure. Now think of it. In the United States, half of our private sector jobs are local small business. I've just shown you that they're competitive and they're profitable, and yet none of our long-term capital is going into those businesses. And in Australia, the number is more significant. It's 70%. So I became very interested in sort of thinking through what are the structural barriers that created this problem. And the biggest structural barrier is securities laws that we created during the Great Depression. And we created in both of our countries a kind of a system of investment apartheid. If you are an accredited investor, and these numbers are US numbers, but the numbers in Australia are actually quite similar. So if you earn $200,000 to $300,000 of income, or if you have $1 million of wealth, or if you're an institution, you have more than $5 million, you can invest in anything, anywhere, anytime, no questions asked. If you're in the other 99%, can't do it, unless massive disclosure documents are filed. Now, Australia is a little bit more forgiving along these lines than we have been in the United States. But in the United States, literally, a business could not take a dollar from an unaccredited investor without preparing a private placement memorandum that could easily cost you $25,000 or $50,000. And if you wanted to take that $1 from, say, 500 people, you would have to do a public offering that would cost you another $100,000. So you start to understand why it is that so few businesses wanted to go through the legal hassle of taking any money whatsoever from unaccredited investors. If we were, however, to fix this problem, it would mean a shift of $15 trillion from Wall Street to Main Street. That is, the size of long-term investments in stocks, bonds, mutual funds, pension funds, and insurance funds in the United States right now is $30 trillion. So if we moved half of that in a more efficient capital market, it would be $15 trillion. So if I do this exercise with Australia, your super funds are $1.3 trillion. 70% of your businesses are local, and efficient allocation, reallocation would mean about $1 trillion would move into local business, or on a per capita basis in Australia, it would be about $40,000 for every man, woman, and child coming into a community of new potential investment for expanding local small business. Serious money. So, what Local Dollars, Local Sense is largely about is identifying what are the ways that the 99% have been able to start putting money into these businesses. And I'll just run through, this is a short list. I actually do an all-day workshop on this that gets into the nitty-gritty details, but I'll just do this very quickly. So one thing we're starting to see is that local banks and credit unions are creating special kinds of certificates of deposit. So this one is really interesting. Equal Exchange is a fair trade company, worker-controlled fair trade company based in Boston. They struck a deal with their local bank. It was called Wainwright. They've since become Eastern. And the essential deal is that Eastern has a certificate of deposit, the proceeds of which are used for only one purpose, as a line of credit for Equal Exchange. And $1 million has come into the bank, people wanting to support fair trade this way. They know that the CDs are risky. They haven't demanded any additional payments, interest payments, to compensate for that risk, because the social return of supporting fair trade is high enough. And to me, this suggests a kind of a potential for deal making that could occur in every community in our countries, between kind of leading social businesses and local banks to create special kinds of certificates, special savings instruments. Co-ops. In both Australia and in the United States, the statutes that govern co-ops are different from the securities universe. And by and large, co-ops are given not a complete buy, but the regulation at the securities level is much lower than it is with other kinds of businesses. So that means that co-ops have effectively been a way that people have done local investing in the last 50, 100 years. Sometimes it's just in their member capital. Sometimes they lend money to the co-op. Say in this case, Weaver Street Market in Carrboro, North Carolina, wants to build a third store for $1 million. They borrowed money for their members and paid them back at 5 to 7% per year. There are examples I have in my book of co-ops that set up their own revolving loan funds, co-ops that invest in other co-ops or other local businesses as a way of supporting them. One of the problems in both of our countries is that short of going public, you can only approach investors with whom you have a pre-existing relationship. This is a limitation. You can't do advertising as a way of bringing investors in. So this guy, James Fraser, former hedge fund manager, went back to his hometown of Port Townsend and set up a network called LION, the Local Investment Opportunities Network. And he basically has a party once a month where he brings investors and businesses together. They break bread together, they drink together, and at the end of the party, he makes a list of who now has a pre-existing relationship. And that then defines how he circulates business plans to comport with state and federal securities laws. LIONs are now spreading around the United States. Kickstarter. Kickstarter in both Australia and the United States, Indiegogo, other similar sites, these are not regarded as securities because people don't really get interest or a return. They get a t-shirt. They get a thank you note. In this case, if you gave enough money for this brewery, you'd get a beer named after you. But the securities authorities don't regard that name as worthy enough as a security. And what I think is so interesting is Kickstarter is the clearest evidence that economists thinking about investment is all wrong. Because who would possibly put money into something for nothing? And yet Kickstarter last year got $100 million into businesses in the United States.
And they've had, for the first time this year, they've had more than 6 projects get over $1 million each.
Wow,
And
I didn't know that.
Yeah, and the first 4 happen within 6 weeks of each other, I think in around March, April. So it's like it's been a really big shift all of a sudden.
That's interesting. Well, all right, and so these other sites are familiar too. Kiva.org is, you know, the electronic version of Muhammad Yunus. Prosper.com is P2P internet lending. In the United States, Kiva is not regarded as security because people just get their principal back, not interest. Prosper took the position that it was not a security either, and then the SEC shut them down and they had to do $4 million of securities work. But now it's available. One point to make about Prosper, Kiva, Kickstarter is that I'm nervous about them because they support a lot of investment relationships that are long distance and impersonal. And so we're recreating some of the problems in the existing system. So I'm impressed with something called the Funding Circle in the UK, which actually creates community-based networks that bring in specific places like, you know, Manchester and Birmingham, investors and projects together to have the local relationship. Preselling is not considered a security in most states in the United States. So for example, Awaken Cafe in Oakland needed $100,000 to create a new storefront. They didn't want to waste $100,000 on attorneys, so they decided to sell $1,200 worth of coffee when the store opened for $1,000 today, and got most of their money that way. Okay, now we get into interesting stuff, which is local stock. In the United States, we have a very complex security system. That is, every state has a securities regime, and the federal government has a securities regime. But it has always been an option for a company to go public within a state. And that is probably as close to going public and staying local as you can get. So an example is the Merck or Mercantile in Powell, Wyoming. Powell, Wyoming is a remote mountainous community. They needed a place to buy socks and underwear, a general store. They decided to issue local stock as a way of financing this store. And they sold the shares like Girl Scout cookies. Now the key to doing this was they got volunteer legal assistance, which again raised the issue of what the heck are we doing with securities law? In Australia, you've had a little bit more action through the Australian Small Offerings Board, started and run by Paul Niederer. And you know, he facilitates up to $2 million offerings for as many as 20 unaccredited investors. So that's what you're able to do in Australian law right now. And what it costs a company to go through this process is, I think, $9,000 prior to the offering, and then you have to surrender, I think, 8% of the offering once you make it. So you have had a little bit of a process for small offerings up and running in this country. My frustration with this system can kind of be summarized in this one point, which is, it dawned on me that the whole purpose of securities law is to prevent grandma from buying swampland in Florida that's worthless, right? That's the kind of thing that people always say. Grandma buying swampland in Florida. Grandma can go into any one of 1,000 casinos in the United States. And when she walks through the door, does grandma get asked, "Excuse me, grandma, but are you an accredited gambler?" So there's no income requirement on grandma losing her money. And then before grandma sits down and plays blackjack, do they say, Grandma, have you read through this thick disclosure statement on all the risks of playing blackjack? No. So we have one system called gambling, where everyone plays and you are likely to lose everything independent of income. And we have another system called local investing, which says, sorry, you can't play, even though we know this is critical for the success of our communities and our economy. This infuriated me. So I started writing about these contradictions about 3-4 years ago. I wrote a piece for the Federal Reserve has a journal in San Francisco, and I mischievously offered a proposal, which was, let's have a $100 exemption. $100, no questions asked. $100 was no more risky to grandma than going to a new Chinese restaurant, dinner for two, right? We should not get exercise about it. Then some friends of mine wrote a petition to the Securities and Exchange Commission to make it a rule. Hundreds of people wrote in letters. Nothing happened. 2-3 years go by, nothing happened. So last year, the Tea Party Republicans controlling the Government Operations Committee on Capitol Hill had Mary Shapiro, head of the Securities Exchange Commission, sitting before them. And they were grilling her on all kinds of stuff. And one of the Tea Party politicians said, so whatever became of this $100 exemption proposal? And she said, well, we've got a bunch of these proposals, and we may get some people together as a committee to start looking at this in 6 months or a year. They just went ballistic. I mean, we're in the middle of the worst recession in 75 years. And, you know, they're like pretending there's no emergency to solving an employment crisis right now. So they, as a committee, passed not a $100 exemption, but a $10,000 exemption, unanimously. It passed the House, you know, 417 to 10. It then went to the Senate, and then, you know, there was a lot of concern about the number. It got whittled back to $2,000. There was a need to put desire to put some website intermediaries in there. But then, you know, by April, in the Rose Garden, President Obama signed the Jobs Act to make crowdfunding legal. And I think what's interesting is that for the first time in 80 years, local investment is legal, that any individual can put up to $2,000 into any company with very few questions asked. And if you earn, actually, it's $2,000 or 5% of your income up to $100,000. So you actually can put more, and then above $100,000, it gets to be much more.
What is that standard in Australia?
What's the standard?
In Australia.
The standard is, well, it's a different system. So the standard is no more than 20 unaccredited investors can put money into a small offering of under $2 million. Now, so in a way that that's why I put the small offering thing up there, because you made progress on one of the points to make the small offering relatively inexpensive, but you have to break down that 20-person limit. You got to get rid of that in order to facilitate crowdfunding. So I think it shows, you know, how far things can come, because I frankly, even in my book, which I put to bed at the end of 2011, I predicted this legislation would go nowhere. Now we're going to have a proliferation of stock issues with people trying to buy and sell local securities, but they're not going to have a market for doing it. So the next stage of all of this will be the creation of local stock markets. So this guy on the left, Michael Van Patten, some of you may know him, he is providing an internet platform for about $50,000 to $100,000 for a community or a region to create a functional stock market for small securities. This guy on the right is one of many smaller scale entrepreneurs who say $100,000 is too expensive, we want to do it cheaper. So this guy is creating his own kind of grassroots stock market. His name, interestingly, is Trexler Profit. Once we get local stock markets, we still need funds. And I think one of the problems with the crowdfunding universe is that, you know, we're inviting people to do these one-off investments, which are highly risky, even if you love the company, even if you trust the company. And we're still making it difficult for people to pool their money. And nothing in the crowdfunding reforms touches the parts of the Securities Act from 1940, the Investment Company Act, which is about pools. We have 7,500 mutual funds in the United States, and not a single one invests in local small business. Even the socially responsible ones, the Calverts, the Everences, they do not invest in local small business. And there's no legal reason they can't do it. It's just institutionally they haven't ventured out in that direction yet. So the closest that we've come is we've got a half dozen funds in the United States which are nonprofits. They're revolving loan funds that allow unaccredited investors to put their money in. They're all intrastate. So an example is this guy, Steve Fireman, has something called the Economic and Community Development Institute, they have, I think, 14, 15 revolving loan funds. The most recent one is opened up for unaccredited investors. So, last on my list is the secret weapon for the moment of local investing. So secret that a dummies book has been written about it in the United States, which is the self-directed IRA. Because people in the United States don't appreciate, and I'm impressed that a lot of people in Australia do appreciate, but they don't appreciate that they can take money out of their vanilla-flavored IRA or 401k, which can only go into these 7,500 non-local mutual funds, and put that money into any local business that they want through a custodian that they pay maybe $200 a year. Now, I don't know the fine print around self-directed supers, but I'll tell you the fine print around self-directed IRAs, which is everything I just showed you, you can put your money into. You could put your money into pre-sales, you could put your money into co-ops, you could lend money to your co-op, you could put money into bank CDs, you could put money into emission markets apparatus, you could put it into Steve Fireman's fund. The only thing you can't put your money into is your own house or your kid's house. But interestingly, you can put your money into your neighbor's house. And your neighbor can use his self-directed IRA to put his money into your house. And therein lies a business opportunity for next year.
Just a question, Michael.
Yeah.
IRA?
Yeah, so investment retirement account.
Okay, so same as superannuation?
Yeah.
Okay.
Well, and we have a number of, it's a whole alphabet soup. So we have 401ks, we have 403bs, we have special subcategories of these things. We have Roth IRAs, and they each do slightly different things. But the important point here is they're all tax deferred. Now, Roths are not tax deferred, but
we can think of them as similar to our self-managed superannuation funds.
Yeah.
Except self-managed super has a lot of security requirements as to what way you can invest it.
Right. So there may be a need to kind of look closely at that. So the question that everyone comes up with is, okay, great idea, good for social return. Could I possibly beat Wall Street? And if you have a loser social life like I do, where you're like running around all the time doing stuff like this, many Saturdays I'll find myself at home listening to bad radio on the AM band in the United States, and there are these investment gurus who are, have their weekly shows, and they are convincing you that leave your money in Wall Street 10 years, 20 years, 30 years, you will assuredly get an 8 to 12% rate of return. That's the kind of numbers they throw around. So I just show in my book that if you look historically at Wall Street, if you take inflation out, if you don't do the ritual of annual reinvestment, the typical annual rate of return, and this includes dividends, is 2.6%. And at 2.6%, actually a lot of the investments sitting around this table look really good. I'm always struck in conversations like we're going to have that people say, well, it's not really investment grade. Come again? Investment grade is 2.6%. Okay? It's not bullshit grade, is what you're really saying. And I think 2.6% is, not every local investment's going to reach, beat it. A lot will. And so we have to reinvent this whole industry in order to get quality control. And so all of the tools that we're developing, whether it's evaluation of the bottom line, evaluation of the triple bottom line, evaluation of sources of capital, evaluation of the entrepreneurs, we have to build the system for local small business as this whole system unfolds.
Well, do you want to follow up questions pretty soon?
Yeah, I'm at the end.
Okay, cool.
And so I would just point out that some of the things that I talked about actually do pay more than 5% per year. And last point, last slide, is just to point out that thinking about the United States context, how quickly could a $15 trillion shift happen? And here's what I would ask you to consider, which is when the first $1 trillion moves from Wall Street to Main Street, what happens to the price of Wall Street securities? Goes down. And what happens to the price of stocks at the local level? They go up. This captures people's attention, and the next $1 trillion moves. So I think this market failure could be fixed relatively quickly. I mean, I'm not talking about 10 minutes, but maybe in the course of 10 years, there could be this magnitude of shift. And 10 years from now, we could have a really interesting conversation about all of this.